Hedgeless Horseman here. It's June the 25th, 2024. In this video I'll go through some news, some company news, and some Copium, because that was requested. Let's begin with looking at... first of all, thanks to the sponsors. Let's look at some news. A major landslide at a heap leach pad at Eagle Gold Mine in Yukon, Canada. So apparently Victoria Gold's heap leach pad failed, and you can see what happened. So this is obviously not good, because all this ground was I don't know what the technical term is, but it's like, you're kind of building a pyramid. That's supposed, how it's supposed to be, and that takes time. So you build from the ground up, let's say. And when you have something like this, this is obviously not too easy to put back in order, because this is right now pure chaos, kinda. Also, Trevor Hall here has a view of it. So basically, this should go something like that, and you can see the steps here. There's some steps there. But it seems this basically collapsed, and it slid all the way down here. That's obviously a major problem. And the shares are down 81%. I think they were down 86% for a while. I think, the neighbor Banyan down 16%, so they're taking it on the chin as well. I'm not going to pretend to know exactly what this means for Victoria Gold, but they basically went from, I think, a 500 market cap company down to 92 million. I actually bought some at 115, and we're talking 0.0001% of my portfolio. I just can't help it when I see crashes. Because typically there's a bounce and yada yada. But I would say similar, but let's put it like this. I love volatility. That's our biggest edge at stock pickers, basically. Panic and greed. Right? When it's irrational volatility, in a sense. And I would wish, it should only be down 20%, but, stop losses and panic and whatever, so now it's down 81%, so now it's like super cheap all of a sudden. I would love to come to that conclusion, and you think that, I have a, easy 200% or whatever. I can't really say that that's the case here. This is obviously not something you just walk off. This is not something like, the ball mill bust or something, and it's like, it's gonna take 1 to 2 months to replace, so that's probably, maybe the stock is down 10-20%. I have no idea what's gonna come out of this, and unfortunately it's not good PR for mining, obviously. So I don't know how this affects the sentiment around Yukon. Might have, this was probably a big employer, so there's got a I'm not gonna say probably, but this might affect a lot of people in the area. It might probably gives a black eye to the mining industry. But as far as I can tell, nobody got hurt, and I don't know if there's gonna be environmental repercussions, for example. What happens on that front. So I hope it's more of a, yes, this is a problem that's going to cost a lot of money and time, but nothing beyond that, like mostly company specific, for the whole Yukon unisector's sake, basically. But sad to see, and this is, what is it, several months after SSR Mining had that catastrophe in Turkey that actually killed people. It's just a kind of, an example at least of how brutal mining can be. Because if you own Victoria Gold at 500-600 million, and it's like, I'm ready for the bull, we have a multi-million ounce deposit here, they can probably grow it and all that, so you're sitting there it's like hoping that in time the gold bull gets going, beta plays like this are gonna go up a few 100%, and then you get minus 80%, and it's like I'm not gonna say the mine is gone, but it's like, okay, this is a major problem. So it's like, it's not like we're at the euphoric highs of or the highs of 2016 in sentiment, or the euphoric highs of 2011. No, it's like getting kicked in your teeth when you're already down. I mean, that's kind of, I think, that's probably what it feels like being an investor in Victoria Gold right now. But it's one of those cases where it's like, let's say, own Victoria Gold. Could you foresee this happening? I sure didn't. So it kind of goes back to red pine. I mean, sometimes we lose because we make mistakes, let's say. And we hopefully can identify those mistakes. And sometimes we lose without making mistakes. Sometimes we win while we're making mistakes, and sometimes we win when we haven't made a mistake. So it's like you can't just look at what happens like, oh, you got to be dumb to whatever invest in Victoria Gold. So how on earth is anybody supposed to know that the heap leach pad was gonna collapse? Who could possibly, how could one possibly know that? Unless one maybe had whatever, looked every day at satellite images and it's like, I see something happening there because I've seen some satellite images on Twitter. My point is that, yeah, let's say you have a bad year, or it's like the last 3-4 years have been bad. You're in Victoria Gold and you just get kicked in the teeth with this. Of course, you're probably gonna feel very dumb, and it's like, oh, I'm already down, and now this happens to a position of mine, and it takes a toll mentally. I guess this goes into the copium a bit. My point is that, like, if there's no possible way that you could have foreseen this, you can't chalk that up as a mistake. Sure, one could have said, oh, I shouldn't have been in Victoria Gold because I didn't like the risk reward, forgetting about the fact that, about there even being a possibility of a heap leach pad failure. Sure, that might be the case, if you can rationalize it in some other way. But just looking at what happened here and the stock price, and it's like, oh, I'm by default a moron because the stock went down 80%. No. That's just going to hurt you in the long run because you're going to take everything personally. This is a shit happens situation, basically. You got to forget about it immediately. Again, it's like, why take it personal if you can't possibly have foreseen it? You know what I mean? It's like, I don't know, the sky is blue, you walk out with an umbrella, for some reason you get hit by lightning. It's like, oh, the regret. Oh, I should never have had. Well, in that case, you probably shouldn't have had an umbrella if the weather was fine. But I hope you get my point. That it's like, no, this is a shit happen situation. This is nothing to take personal. Same actually with drill plays, and especially, let's say, early stage discovery, pre-discovery phase. It's like, most of them, in that case, that's high risk though, most of them won't pan out. But just because they miss and the stock goes down 50% doesn't mean it was a bad bet by default. We just see what happens. If they would have made it, it's like Condor, for example, which I, lost a lot of money on quite recently. I can't say that I, regret the bet, because things would be very different if they immediately hit the Pucamayo. It's like, as good as it looked, it was actually, given that you saw the outcrop and all that. So it's like, yep, and the geophysics basically backed up the story that, yes, this looks like silicification, oxidized, whatever. And it's like, boom, we have an outcrop for 800 meters. Let's drill this blanket. they missed it at least so far. But I think that was a great case, and I wouldn't have complained about having a big position if the success I hoped for would have materialized on the maiden drill campaign. I would be, it's like my portfolio would be up a shit ton. Instead I get kicked in the teeth. But that's the double-edged nature of it. At least in that case, you saw the risk. In this case, again, it's like you can't even. How on earth, what percentage of a discounting should I use for like possible dam, heat bleach failure, possible whatever, earthquake? No, it's impossible. So I'm just trying to say, I mean, there's rational regret and there's irrational regret, and it's like when I took that hit in Condor, it's like, yep, it stung for, and that was my biggest loss ever in a day. Especially, I think it was, probably, especially in monetary terms, in one stock. But felt bad for like a day, but it's like, no, back to the grind. I signed up for it. I would be cheering if they hit, they missed, so now I'm down a lot. But I wouldn't have had the chance of a very rapid appreciation unless I was in. So I'm disappointed that the results weren't better, but I don't take that to mean that's like, that was a bad bet. No, we just saw what happens. Nobody can predict what any single drill hole is going to show. Hard day here. Personally, again, it's like, yes, I like the fact that you see something down 81%. It's probably going to get very volatile. I mean, it was down to 1.1. It's already, I mean, it means intraday volatility and all that. But like, how big is the, why can't I see the graph was much nicer recently. Oh, okay, maybe it isn't a clear one than this. Anyway, it's like huge volume. Again, it's like there's probably some volatility trading one can do, but I want to be able to see the future, or at least have a good grip of the risks before, let's say going in bigly in anything. And this is kind of, almost like the Red Pine situation, where it's like, I don't know how it's going to play out. It could be super cheap, could not be, but it's like I can't really tell which it is. So I mean, maybe Victoria Gold, maybe this, people who bought this dip, maybe in 2 years they're gonna look really smart, but maybe not. I just don't see it as a slam dunk bet the farm kind of situation. So I probably will not be, even though I actually really, I mean, when I see anything crashes really, most of the time it's overdone. Question is how much, right? Because this is obviously tangible value destruction here, and I have no idea what's going to happen, because I don't know, are they going to get any revenues? I mean, what if it costs $50 to $100 million to sort this out? It's not the best situation, right? Okay, to the Copium a bit. Well, more of the Copium, I guess. Bear market forces us to get better. I mean, that's the best part of them. I heard, I think I've talked about this before, but Rick Rule was interviewed not too long ago, and he was asked, like, what do you think about the sentiment in this sector? Is it, too bad or whatever? And it's like, is it detrimental, or should we feel sorry for ourselves? And he's like, no, I think this is, pretty good sentiment, in the sense, according to him, and I'm paraphrasing a bit. Sorry, Rick, if I'm misinterpreting what you said, but basically his point was that, to my understanding at least, that it's filtering out a lot of companies, like the really crap companies, or the really crap projects, or really crap management teams, let's say. They have a very hard time getting any kind of money right now. Not that all of them won't have any value or anything. It's just that there's not enough capital, there's not enough shotgun kind of retail buying or general investing to have it spill over to everyone. It's not a bull market yet, at least, and it's not a fully fledged bull market. But the companies with solid projects, sure, they probably on the cheap. I mean, but that's when you want to buy them anyway, right? I mean, so that's the beauty of the bear market or low sentiment environment, at least. That I mean, if you want to buy cheap, you kind of have to be in a poor sentiment environment. Otherwise, it's going to be increasingly hard to buy cheap. At the sentiment highs, I mean, it's really, really hard to find something that is actually undervalued. Then it takes a lot of due diligence to find the ones that might still be undervalued, the very much unknown ones. Now you have, it's like, well, the whole sector is kind of in the toilet still. And you have some that are sleepers, and if the sector is cheap and you find a sleeper, now it's like a compounded undervaluation in some cases. But that also means that now is the value of due diligence is the highest around the lows, because there's stuff out there that probably are going to go up 1,000% over the next 3 years, say. Nobody knows exactly which ones they are, but some are. Some are going to go up 2,000-3,000%, I think. Some are going to go down. Some are going to go up 300%. I mean, it's like the spectrum of outcomes from these levels is huge. But again, it's like a lot of the time we have seen this thing where it's like companies put out good news. Nobody bids up the stock. That's an opportunity. Companies come out with negative news, let's say, and they get absolutely slammed. Maybe slammed too much. That's also an opportunity. That's the kind of opportunity versions you get in a low sentiment environment, right? Something starts off cheap, puts out some bad news, but it's like, no, it was already cheap and already kind of priced in that news, and it gets even cheaper. You have no idea. Maybe that's going to go up 500% in the future, if the story is still intact and all that. Or you find cases where it's like, holy crap, I mean, this is a very material news release, especially if you're looking at a 15 million market cap company. It's like, just this news, whoa, they defined a big target, or they had some real success. It's like, for a 15 million market cap company, it's like, maybe if you risk adjust the news release, it's still worth like 10 million on a risk adjusted basis. That's 67% of the market cap that just got added in risk adjusted value, and the stock doesn't do anything. And that's obviously huge, especially if you thought it was cheap to start off with. But it's like, yeah, going back to Rule's point again, it's like, I mean, my first bull, 2016, it felt like printing money. Actually, 2020 also at the top, I even said that to, I don't know if it was my brother or a friend, like, it's like printing money. It feels like that. So I've seen that show before. I knew I was making money too easily, because everything was going up without any meaningful news, and they weren't even cheap, perhaps, relative to what already was known. So they weren't really cheap, but they just kept going up, getting overvalued, probably some of them. But I don't sell. I don't market time. I didn't exit because I had that feeling. No, I always try to value shuffle. It's like, okay, this might have run too much. Maybe, I don't know if it's still cheap or not. But I found another one that I think is, I'm pretty sure it's cheap. Then I value shuffle. But then the bear came of like, from 2016-17 to, maybe we can see that in GDX easier. Then this, I mean, I felt like an absolute genius here. Portfolio went up like 500% in 8 months or something. Crazy. Then this happened. It's like 2 years of basically losing money or breaking even. Only a few stores really worked out well. But that's kind of the point. But it feels very terrible where it's like, even if you do a lot of due diligence, when the sector is still not really hot, and you're like, oh, I put in a bunch of due diligence and on whatever stock, and it's like, it's up 50%, whatever. It's still, let's say, your portfolio is still down from the highs of 2020. So you put in a huge amount of effort, and it's like, oh, they had a rally recently, but now they're already, well, excuse me, getting a bit boring again. It takes a mental toll. Because I know it's like everybody, and kind of myself included, that we're like, we're hoping for this. Pain stops and it's like immediate gratification. Absolutely immediate gratification. But let's not forget, there's like just this kind of trend here, for example, and I've talked about this before. This was a 50% rise in a very short period. If that keeps up that trajectory, I mean, it can't, basically, because just in this leg here, it's like we can't expect to make that kind of money, because like GDXJ would be up. Well, okay, this doesn't even look that super unreasonable. But still, I mean, these are huge returns. I mean, imagine, it's like, okay, April already up, whatever, let's see, you're up, oh jeez, or March, April, 230, I mean, from a compounding perspective, that's still absurd, 237% in a year. You'll get richer than Buffett in 10 years if that kept up. So we shouldn't expect or like demand that, yes, actually this was absolutely ridiculous, obviously. I mean, this this was kind of a growth pace like this. It's just that it kept on going for a few months more. But that's not something that we really need. It's just, even if you're down 50%, if one could average, I don't know, from the lows here, 40% per year, let's say. I mean, you're not, in that case, if you're down 50%, you're not even up to break even yet. But from these lows, if the next 3 years average is 40% per year, or next 5 years or whatever, you're still going to be making money. It's just not, yes, it might not sound like a lot, like I signed up for 10 baggers and all of that. But that's very rare, and we have no idea what could happen with some of these juniors. This is just the GDXJ stuff. My point is that it's like Felix Zulauf believes this is we're gonna have a commodity bulls that goes all the way to the end of the decade. We're in 2024 right now, and that, of course, even if he's right and it's gonna end in a big bubble, that doesn't mean there's not gonna be any corrections. I'm strapped in for, well, I don't really care about the metals or silver. It's like what I own, I think, is super cheap. If gold goes up or down tomorrow, doesn't matter at all. Because there's no way it's going to go down enough that it's cheap, and it's almost no way that the stock is just going to, if gold goes up a bit or gold is stagnant, whatever, tomorrow, and it's like there's no way that juniors are just going to shoot up 200% in one day, and I have to make a decision. It's like, oh, these cheap stocks, they're actually overvalued now all of a sudden, even relative to, let's say, or not as cheap or whatever, to 2,300 gold. That's not going to happen. So it's like there's no real point in watching the portfolio too much. The value of the companies, they change on news days. How many news items does a company typically put out, average junior, in a month? 1 or 2, maybe? And of course, I mean, going into the drilling season, all that. So that's going to change, obviously. So we're now at a kind of a boring period where we haven't seen much news. The Northern juniors just started drilling, but that's something we have to account for as well. Yes, the recent past has been boring because most of the drill seasons haven't begun even. But when the drill season starts, companies can make discoveries, companies can put out good ass results, the sector can get a bit more exciting, and obviously it's typically from the assay results that companies tend to have that quantum leap potential, like we saw Ramp, for example, Ramp Metals recently put in one really good hole, stock is up like, I don't know, 500-600% or something. That can happen unless you drill, and most companies have just begun drilling. So we're going into the more news heavy period for the rest of the year, actually. And if we believe that, hey, Felix Zulauf, he believes there's going to be a commodity bull, and sure, there's a lot of arguments for it, I would say. I mean, gold, just look at the state of the world and look at the state of the economies, look at the state of the, fiat currency. Look at the state of the, tech bubbles and all of that. And the crypto bubble, which still is alive. So it's like, we're not in the end game by any stretch of the imagination yet. Or I think we're in the end game. It's just that it's, at the end of this, I think pretty much all crypto has basically evaporated. Obviously, that's not the case yet, even though Bitcoin is taking on some water. Recently, it dipped under 60,000. I don't know where Bitcoin is going, but I know for sure that 15,000, 15,000 different cryptos sure as hell doesn't have value. So it's like, yeah, that's in my opinion, like the canary in the coal mine. When we see crypto going down to its intrinsic value, by that point, I think real assets are going to be much higher. That's yet to come. This, I don't know if this is a topping pattern or whatever, but it's like it's been chugging basically, going sideways. Maybe, Nvidia is starting to at least have some kind of correction. We might be at the cusp of something. Like this tweet here from Correlation Economics. To predict a recession, you can use SAM rule, McKelvey rule, Mel rule. Two of them have triggered. Again, I don't know. I don't try to predict this stuff. But it's good to be reminded. Just because it feels boring and it's like, whoa, the gold is not working out or the gold mine is not working out. We have no idea how close we are to the final revaluation of hard assets. We have no idea. Could be the big thing could be starting tomorrow. We have no idea. We just know that commodities are cheap, supply and demand looks great, and Victoria Gold, that's less gold to the global markets. And we know solar is basically growing kind of exponentially still, I guess, and it eats up a lot of silver. And copper, the AI data centers, I saw something recently, just how much the world plans to be investing in these data centers. It's just incredible amounts of copper that would be needed in that case. So yeah, copper has a correction, can be a bunch of different factors, maybe it's a recession, whatever. We just don't know. But the thing is, if you buy cheap, most copper juniors, I would argue, already are pricing in that they probably have no chance of having something that's economic anyway. They're not pricing in a rosy picture. The gold juniors are certainly not even pricing in the gold price today. So as the way I see it, what I own is cheap. If it goes down tomorrow because gold went down or Nvidia started taking on water or whatever, that just means cheap got cheaper. And if the plan is, okay, I'm going to stick it up, I'm going to hold, I'm going to do a bunch of due diligence, try to find the best companies, because let's face it, and I've talked about this before, let's say your entire portfolio is down 50%. Every single stock is down 50%. Well, there's a bunch of other stuff that's probably also down 50%, and just maybe, you should replace 80% of your holdings for something else that's down 80%. And maybe your future expected returns go up by 200%. This is not a time to be lazy. This is, again, it's rigged against the holder, but it's still rigged for the buyer in that case. If we're value shuffling, at least we're both. Because yes, I'm a holder, and I sell to buy something, so I become a buyer. So this is no time to be, I should say, yes. Let's say, don't let the quiet, boring markets fool you. And somebody recently told me there's a saying, it's like never sell a boring market. Because now it feels, in my opinion, very boring. And I just think that stuff can blow up at any point in time, really. And if you hold something cheap, it shouldn't even need a trigger, even though, yes, the sentiment is typically the trigger. We just know that looking at the juniors, they're nowhere close to being overvalued. And this sector always becomes overvalued. But in the meantime, there's a buffet out there for the prudent, serious due diligence investor. Just throwing up your hands. I mean, you should get greedy. If I find a case that's like, whoa, that's down, I have no problem selling something that I'm down 50% on if I find something that I think, whoa, I mean, what I sold I think can go up 200%, but this I think has a shot of going up 300 to 400%. I get greedy in that case. I feel like I'm making money just from the value shuffling. And that comes from due diligence and just using the volatility, obviously. Appreciating news releases that the market doesn't. And you know, the saying is, people should be agreeing with you later. But I can understand. I mean, it kind of sucks because we're still, you know, we haven't popped the champagne yet. From the top here, we're closing in at, 4 years. It's a long time. And what obviously helps, which I try to point out, especially around, the lower levels here, is like the best, I'm not going to say defense, but it's like the best thing you could do is obviously, if you just bought more during this entire time, you ramp up your buying, the cheaper it gets, you're lowering your average. So your average is just going down and down and down if you buy. And yes, you might look stupid on every single buy before you start to look smart. And maybe you bought all the way down, so now your average is here, let's say. Or the junior sector is even worse. So maybe actually, let's say up here. So yes, you're still in the, let's say, red, even though, this bop here. But of course, the biggest problem is that most people, absolutely vast majority of people, do not buy. They do not average down. They do not buy when it's lower. They tend to buy here, then they stop buying, maybe sell. But if they don't sell, they don't buy, but they might start buying here. So their average is probably, up here. Whereas again, the guy that just, okay, I'm taking every single dip. My big picture is that this sector is going to get overvalued one day. And then I got to figure out what companies today are cheap and have a good shot of, becoming worth more, whatever. And they can survive if this takes 1 or 2 years. Because like I've said before, when you look at the rallies in this sector, whatever, they're so obscene, especially in juniors, that if the sector went sideways for another year and we're down 60%, so let's say 5 years and we're down 60%, if the real move starts in 5 years and you're down 60%, and you use the time to just due diligence, hold it out, stomach the volatility, stomach the boring period, just average down, do more due diligence, you constantly make your portfolio better and better and better in quality. The more you read, the more due diligence you do, etc., etc. At the end, if you're down 60% and the real, a real bull market starts, 60% is going to be a cakewalk. So, theoretically, let's say by year 6, from 5 to 6, the sector goes up 500%. Your portfolio, or let's say your portfolio goes up 400%. You're going to be up a lot. The more you bought, the lower your average is, the more you're going to make. The better your stocks that you pick, the more you're going to make. It's just that, yes, in hindsight, up to that period, 5 years it sucked. It absolutely sucked, let's say. And the worst thing, of course, is that you become depressed. You stop trying. You just wait for the gold and silver. You just watch the silver price hoping it to bail you out. You're too apathic, let's say, to even do due diligence because it feels like nothing. It doesn't matter. Everything goes down. And you don't average down. Now you're going to wait for the coast to be clear and all that. That's ways of shooting yourself in the foot. Doing what's right when it's hard is hard. But over the long term, that's where you get all your edge. That's what separates the winners from the losers, really. To be able to do that, to be able to suffer through years of dreadful action in a cyclical sector and just reminding yourself that I know how this sector operates. Like Pierre Lassonde says, it always crashes and always rallies. We are still waiting for the rally. But if you know a rally is coming, that's what you should focus on, and then focus on, okay, and watch if you're investing in junior miners, for example. Which companies do I think, will do well, will probably do well. I mean, the probable returners are best, obviously. Who can stick it out for, let's say, a year or two, at least. Do they have access to capital? Do they have good people? Can they not go bankrupt and stuff like that? Because I see a lot of people a lot of time complaining that, but they dilute and whatever. Yes, there is dilution and all that, but still there are some companies that dilute more than others, and of course some that dilute less than others. So that's not a good way, again, to just throw up your hands. Well, everyone, every company dilutes. It's like, yeah, especially if you pick the one that are serial diluters, etc. Let's say they're not good cases, it's not good management. Yes, it's going to be even more dilution in that case. But that doesn't mean that you, that basically, if you throw your hands up, you shouldn't expect to have really good returns. It's like, while saying this, I do think that most people should probably not even be in this sector. If you get this, if you can stomach it, if you do the due diligence, simply because it's one of the most volatile sectors, I think you can make more money in this sector than most other sectors. It's just that it takes a lot of time, energy, and extreme patience. Most people don't have that. Most people should probably buy an index, not even a mining index, but I guess, if you're bullish on gold, maybe GDX, GDXJ. I don't really see the edge there, personally, that much. What's it going to take for Barrick to go up 100% in value and all of a sudden look cheap? That it should go up 100% in price, meaning that the value is twice as high as where it is. Is Barrick that cheap? No, we would need a gold bull, obviously. So you might get a few 100% returns, depending on how big the gold bubble gets, of course. But I don't see the superb risk reward. Mining companies are more famous for destroying value over time, not creating value. But yeah, I guess the point is that this is how it is. It should be it's really a grind, especially if you don't really understand. I think once you've seen the cycles a few times, at least seen a low from a high, you understand how quickly everything can change. You get it. It's like, yeah, I've seen this move before. It's cyclical. We topped here. Sentiment was really high, bear market. Sentiment was really low, bull market. Sentiment was, I'm not going to say really high, but it's like pretty high, bear market. Then you know what the next step is. Because we're much farther from a top than from a bottom. Because nobody can look at the juniors and say, whoa, slow down there. This company is almost pricing in like they have a 5% chance of finding something, etc. No, it's just ridiculous. It's cheap. It's cheap. That's all there is to it. The best you can do is probably, again, do your due diligence. The news is actually what changes the value of the companies, even though they change in price every day. And then, honestly, probably try to enjoy the summer. But also, I think a good point is, like, it doesn't matter what has happened. If you lost a bunch of money on a bunch of juniors, what better time than now, in that case, to sell all your holdings and actually buy the ones you think have the best possible chance of making it? Because, like, when things get going, or and especially if a company is successful, it's like 100 to 200% is going to be nothing. When we go into a full-blown bull, the ones that actually do end up making, discoveries or proving up discoveries or doing whatever to create value, they're probably going to go up hundreds of percent. So if you're down a lot in stores that are mostly dead, like they failed, or they drilled, they didn't hit, or whatever, you kind of know that, this junior is like, it didn't pan out as I hoped, which is fine. Most juniors don't pan out as you hoped. But it's like, I don't want to sell here. You don't need to make back the money the way you lost it. I don't necessarily expect to make back the money I lost in Condor, even though that could happen. But I have taken money off the table. But that's, it sucks. But it's like, you gotta swallow that bitter pill, and it's like, okay, your money is always supposed to be where it has the highest expected future returns, expected value. You don't need to sit in stuff where all of the cases, or many of the cases, have failed. And yes, if a bull starts tomorrow, they might go up 300% in the next 6 months. But that's kind of true for everything. And it's true for the better juniors with intact stories. They might go up 400-500% instead. So that's not either a good excuse. Like, we just need the market to turn. But it's like, but that goes for all the other juniors and perhaps better ones. Anyway, long rant. I'm actually probably gonna just cut this video right now. I need to take a sip of water. It's so hot. Consider me biased if I talked about any companies. I assume I own them. If I mention any companies, there might be banner sponsors as well. Consider me biased. This is not investing advice. Do your own due diligence, etc. Bye bye.